Diversification. Don't put all your eggs in one basket. The only free lunch in investing. If there's one timeless piece of investing wisdom, it's this. Don't put all your eggs in one basket. In finance, this principle is called diversification, and it has been described by Nobel Prize-winning economist Harry Markowitz as the only free lunch in investing. Why? Because unlike most things in finance, diversification gives you something for nothing. Reduce risk without sacrificing expected returns. Bonus tips. By the end of this lecture, I will be showing you sample diversified portfolios by age that will be paramount in your money diversification journey. What exactly is diversification? Diversification is a practice of spreading your money across different assets, industries, and geographies, so that no single event can wipe out your wealth. Here's the idea in plain English. 1. If you buy just one stock, your entire portfolio depends on the success of that company. If it crashes, so do your savings. 2. If you own 10 different stocks across multiple industries, the failure of one has a much smaller impact. 3. If you expand further into bonds, real estate, commodities, and global markets, your portfolio becomes even more resilient. In short, diversification means not putting your future on the shoulders of one outcome. Why diversification works. Different investments don't always move together. Economists call this low correlation. When stocks fall during a recession, government bonds often rise as investors seek safety. When U.S. markets slow down, emerging markets or European stocks might perform better. When inflation rises, real estate and commodities may protect your purchasing power. This balancing act creates smoother long-term returns. You won't always capture the absolute best returns of the year, but you'll avoid catastrophic losses that can set you back decades. A simple analogy from everyday life. Think about how you already use diversification without realizing it. 1. Career skills. You don't rely on just one ability. You build multiple skills to stay adaptable in a changing job market. 2. Friendships. You don't rely on one person for all your needs. You have different friends for advice, fun, and support. 3. Health. You don't eat just one food. You balance your diet to avoid deficiency and disease. If diversification makes sense in life, why wouldn't you apply it to your money? Case studies. Lessons from the market. Case study 1. The tech bubble of the early 2000s. During the dot-com boom, many investors put everything into tech stocks. When the bubble burst in 2000, the NASDAQ index lost almost 78% of its value. Those who held only tech saw their portfolios wiped out. But investors who diversified into bonds and international stocks lost far less and recovered faster. Case study 2. The 2008 financial crisis. When the global financial crisis hit, stocks worldwide plummeted. A portfolio of 100% in U.S. stocks might have lost over 40%. A portfolio balance with bonds saw smaller declines because government bonds actually gained value during the panic. Case study 3. The resilient balanced investor. Imagine two friends. Sarah invests everything in her favorite company's stock. James invests in an index fund that holds 500 companies, plus some bonds. If Sarah's company struggles, her portfolio crashes. James, on the other hand, barely flinches, because the failure of one company barely dents his diversified portfolio. Common diversification mistakes. While diversification is powerful, it's possible to get it wrong. 1. Putting everything in one asset. Many beginners buy just a single stock, think it will make them rich. That's gambling, not investing. 2. Home country bias. Most investors put all their money in their home market, but history shows no country dominates forever. For example, Japan's stock market peaked in 1989 and has still not returned to those levels decades later. 3. Over-diversification. Holding hundreds of different assets across too many funds can dilute returns and make it hard to manage your portfolio. You want enough diversification to manage risk, but not so much that your gains disappear. How to diversify your portfolio action steps. Here are some practical, beginner-friendly ways to get started. 1. Start with index funds or ETFs. A single S&P 500 index fund gives you exposure to 500 companies at once. A global ETF can give you thousands of companies worldwide. 2. Add bond for stability. Stocks grow wealth, but bonds protect it. A classic portfolio is the 60-40 split, 60% stocks, 40% bonds, though younger investors may tilt more towards stocks. 3. Include different asset classes. Real estate, REITs, commodities, or even a small allocation to alternatives like gold can provide balance. 4. Rebalance regularly. Over time, some investments grow faster than others. Rebalancing every 6 to 12 months restores your intended allocation and keeps your risk in check. The bottom line, diversification won't make you a fortune overnight. It's not flashy, and it won't win you bragging rights at dinner parties. But here's what it will do. Protect you from catastrophic losses. Smooth out your returns over time. Help you build wealth steadily, without unnecessary risk. That's why it's called the only free lunch in investing. Because you gain protection without giving up growth. So the next time you hear, don't put all your eggs in one basket, remember that wisdom isn't just for markets. It's a life principle. Apply it to your money and watch how peace of mind becomes your biggest return. So let's jump right into the bonus tips. Like I promised at the beginning of this lecture, sample diversified portfolios by age. 1. Young investor, 20s to 30s. Growth focused. At this stage, you have decades ahead before retirement, so you can take on more risk. The focus is growth through stocks, with a smaller allocation to safer assets. 80% stocks, 60% U.S. stocks, index fund or ETF. 20% international stocks, developed plus emerging markets. 15% bonds, U.S. or global bond fund for stability. 5% alternatives, real estate REITs, or commodities for diversification. Light bulb why? Stocks dominate because you can withstand volatility over time, but bonds and alternatives protect you from extreme downturns. 2. Mid-career investor, 40s to 50s. Balance growth and safety. You're closer to major financial goals, kids' education, mortgage payoff, retirement planning. The portfolio needs growth with more stability. 60% stocks, 45% U.S. stocks, 15% international stocks, 30% bonds, mix of government and corporate bonds, 10% alternatives, real estate, commodities, or gold to hedge inflation. Light bulb why? You're still growing wealth but can't afford to take the same risks as in your 20s. Bonds and alternatives now play a bigger role. 3. Near retirement investor, 60s and beyond. Preservation focused. The priority now is income and capital preservation. Stocks are still important, but stability matters more than growth. 40% stocks, 30% U.S. stocks, 10% international stocks, 50% bonds. Emphasis on high-quality government and corporate bonds. 10% alternatives. Real estate for income, gold for protection. Light bulb why? You need consistent income and protection from big losses, since there's less time to recover from market downturns. Quick portfolio checklist. Ask yourself these questions. 1. Am I too concentrated in one stock, industry, or country? 2. Do I have both growth assets, stocks, and safety assets, bonds, real estate, etc.? 3. Do I rebalance at least once a year to keep my allocation on track? White heavy checkmark final thought. Your diversification strategy should change as your life changes. A 25-year-old and a 65-year-old shouldn't invest the same way, but the principle remains constant. Don't bet your future on one outcome. If you gain value from this video, don't forget to click the thumbs button, subscribe, and turn on the notification button for more videos like this. Thanks for watching. Don't forget to like, share, and subscribe.